Were you aware that Tesla's stock price may have a scary price tag after the split? While a lot of people are anticipating the 3-for-1 stock split, experts reveal that price targets for the EV company's stock are not something people would like to look forward to. Stay tuned and keep watching to find out more about this. Tesla, whose name is becoming more and more known by the day, recently made noise when it announced plans for a 3-for-1 stock split. Amidst this is the argument as to whether or not Tesla is overvalued or undervalued. Although the stock split aims to make it more available for Tesla employees, some say that after the said split, Tesla's stock price may well possibly skyrocket. In today's video, you will see why experts are revealing scary price targets for Tesla stock after the split. In a 14A filing with the SEC, Tesla clarified its plans for the 2022 annual stockholders meeting, which is set to happen on August 4th. Along with several agenda items listed in the 14A filing, Tesla described its intentions to split its common stock by a 3-for-1 ratio, which will triple the number of available shares and split the price by 1/3 on the day the stock split takes place. This move does not affect the valuation of the company, but simply increases the number of common shares available of a publicly traded company while decreasing the price to make shares more affordable for investors. Tesla said that its board of directors has moved to execute a 3-for-1 split for the company's common stock, which basically means that if you own one Tesla share, you will get 2 more. According to them, this move will make the ownership of Tesla stock more available for both employees and investors alike. We want to make sure all employees, no matter when they join, have access to the same advantages, the filing said. We believe the stock split would help reset the market price of our common stock so that our employees will have more flexibility in managing their equity. For those who cannot fully grasp the concept of a stock split, according to Forbes, a stock split is when a company's board of directors issues more shares of stock to its current shareholders without diluting the value of their stakes. A stock split increases the number of shares outstanding and lowers the individual value of each share. A stock split is cosmetic and could mean that smaller investors feel they can afford the stock, but those investors are minuscule compared to major institutions. However, stock splits don't change the value of a company. For example, investors in a company with a stock trading at $100 that does a 2-for-1 stock split will simply own 2 stocks worth $50 each. The value of their 2 new shares is the same as their prior single share. For stock splits, it is very common for companies to outperform the S&P 500 with a normal 3-month period moving about 2.1%. Post-stock splits, companies tend to move about 7.8%. After 6 months, 4.4% on the S&P 500, 13.9% on a stock split stock, and after 12 months, 9.1% on the S&P 500 and 25.4% on the stock split stock. Oftentimes, stock splits can affect the performance of a stock, since the stock appears cheaper or easier to buy with fractional shares. While the split may be beneficial for aspiring stockholders, how will it affect current stockholders? Existing Tesla stockholders' financial stake will be the same. The only difference is that they will be holding 3 times more shares if stockholders vote to approve the measure. Do you think Tesla stock is overvalued or undervalued? Share your thoughts in the comments section below. One of the most important reasons for such a stock split is to positively impact investor psychology. As a share price goes up, it can start to seem unaffordable. A less expensive stock can be perceived as a weaker value, even if the market cap for the company is the same. A stock split has the potential to increase share affordability. With what is perceived to be a more accessible stock price, investors who might not have otherwise chosen a particular stock could find it appealing. Such a draw could heighten demand and eventually even elevate the stock price. Meanwhile, amidst numerous issues that affected Tesla's production, mainly due to the zero-COVID policy in China, which enforced a lockdown, Barclays is raising their price target on Tesla. Barclays is a British multinational universal bank that operates as 2 divisions: Barclays UK and Barclays International, supported by a service company, Barclays Execution Services. It is famous for being a major global financial services provider engaged in retail banking, credit cards, corporate and investment banking, and wealth management. Again, Barclays is raising its price target on the leading EV company by 14%. This suggests that Q2 production is likely to come in at about 256,000. Although Tesla CEO Elon Musk is pushing for 300,000 deliveries, if only 256,000 were delivered, it would be considered the largest decline in Tesla's history. It may be understandable for others, though, since this was partially due to the aforementioned China lockdown, which in turn affected the Shanghai factory and caused supply chain issues, and the company took longer to get up and running. Moreover, UBS also raised its price target, setting a massive order backlog and a substantial margin momentum. UBS Group AG is a multinational investment bank and financial services company providing financial services in over 50 countries. They are still expecting a 50% growth for the year. They are more inclined to take a year-to-year look instead of a quarter-to-quarter look with an $1,100 price target. They also expect that Tesla's vertical integration and semiconductor software and battery will result in superior growth and profitability. And since batteries are the biggest bottleneck for the EV industry, they believe that because Tesla has its battery construction and factories and manufacturing, they believe that the company is uniquely advantaged or uniquely positioned to drive higher margins with its batteries and actually deliver. As a matter of fact, UBS is so bullish in their bull case scenario that they think Tesla can have a gross margin that could rise from 30% where they are currently sitting without tax credits up to 34.7%, which is quite bullish. UBS has upgraded Tesla to a buy position, saying it now sees more than a 50% upside for the electric vehicle stock. Now, what are the reasons Tesla could soar after its stock split? First, more factories mean more vehicle deliveries. It is no secret that Tesla has faced challenges meeting the demand for its vehicles in the past because of production constraints. In fact, despite the company's incredible growth, a lack of manufacturing capacity has actually slowed it down. However, that might be about to change with the opening of two brand new gigafactories, one near Austin, Texas, and the other in Berlin, Germany. The new additions will take Tesla's manufacturing capacity to 2 million vehicles per year, from 1.05 million previously. Still, the company has to contend with supply chain issues for raw materials and components like semiconductors, which is a problem all car makers are currently facing. Second, more deliveries mean a higher gross margin. A gross profit margin is simply a company's sales minus its cost of goods. In Tesla's case, its automotive gross margin would factor in the price of a car, less the direct cost of making the car. It would include costs such as the raw materials required to build each vehicle, but it wouldn't count marketing or money spent on research and development, since those are operating expenses. As Tesla builds more cars, its gross margin increases because of a phenomenon known as scale. If Tesla builds a factory that can manufacture 500,000 cars, but only produces 50,000, it would lose money because it's absorbing the cost of that extra capacity without actually using it. When it produces all 500,000 cars, its fixed costs are at the smallest possible percentage of its revenue, which leads to a higher gross margin. Since Tesla has been delivering a record number of vehicles, its gross margin has consistently climbed higher, and it's now sitting at the best level in the company's history. Finally, a higher gross margin means a higher net income. Net income is a metric most investors watch closely. It is simply the company's bottom line or profit. It's also important because when it's divided by the number of shares in circulation, it becomes earnings per share. Many pundits predicted Tesla would never reach profitability because making cars is difficult and expensive. Even some of the best car makers, like Ford Motor Company, can only muster a gross profit margin of around 15%. But Tesla has developed industry-leading processes for producing electric vehicles, and the quality of the finished product allows for premium pricing. Tesla's gross margin of 32.9% leaves far more room for operating investments like the design of new products and the development of innovative new software technologies like autonomous driving, which can help keep the company ahead of its competitors. But more importantly, the high margin results in more money flowing to the bottom line. And in the first quarter of 2022 alone, Tesla generated over $3.3 billion in net income. Visit Tesla stock and watch our other videos for more of this content.